There are several misleading myths and legends making the rounds when it comes to cryptocurrency. Bitcoin specifically has been the victim of many misconceptions that have kept it from being embraced by the general public. Today, we will take the time to debunk these fallacies and half-truths and clarify just what Bitcoin is really about while answering some common questions about the enigmatic tender. Bitcoin is a secure and anonymous currency. Even though Bitcoin is widely known as an anonymous currency that is typically secure, the truth about the currency is far more nuanced. While it is private, it is not completely incognito, and it is not as impenetrable as many were led to believe. While there is a much more protection in place when compared to other more traditional financial systems, there are design flaws to consider which reveal vulnerabilities in both its anonymity and security. When it comes to anonymity, it should be said that Bitcoin does contain a public ledger where all transactions are forever recorded. This is simply a part of the blockchain technology in which Bitcoin is founded. And since anyone has the ability to trace and verify transactions, you can make the argument that Bitcoin can never truly be referred to as anonymous. While the transparency is a key feature essential to the network's integrity, this is still a fact that cannot be overlooked. To clarify, the blockchain retains crypto addresses indefinitely, but these transactions do not display personal details. Still, these addresses can be easily traced to specific people and entities with the use of advanced tracking tools, which are becoming more and more common. This is especially true when such individuals interact with any cryptocurrency exchanges that require Know Your Customer verification. Security is another slippery slope when it comes to Bitcoin. Though the blockchain itself is tamper-resistant, wallets where crypto is stored and exchanges where crypto is traded can each be vulnerable in particular situations. Theft, hacking, and even accidental loss are not always preventable, even though the security measures taken are far more robust than those of most banks. There have, unfortunately, been several high-profile matters involving stolen Bitcoin and lost access to private keys, and these scenarios only prove just how risky, though minimally, that any cryptocurrency can be. So, while a moderate mix of transparency and security is to be expected when using Bitcoin, the best practices to prevent any issues include understanding the limitations of blockchain privacy, using only reliable wallets and exchanges, and safeguarding private keys and recovery phrases. There is a division among Bitcoin loyalists when it comes to whether or not the currency has intrinsic value. For example, gold and silver, among other physical assets, have a market worth not unlike Bitcoin. However, the former contains further value for their industrial applications, including their use in making jewelry. As a non-physical entity, Bitcoin's value lies completely in speculation, and with its wild price fluctuations, many feel that it's much more of a product of its own hype than it is actually a valuable asset. As such, critics of Bitcoin believe that its market is no more than a speculative bubble that can burst at any time, similar to the infamous .com bust in the late 90s or the Netherlands 17th century tulip mania. Each of these comparable bubbles were marked by quick, extreme price increases followed by dramatic, devastating collapses. Once the bubble bursts, they argue, Bitcoin will be rendered worthless. But this correlation may be too simplistic, other analysts say. One would have to overlook the unique attributes of cryptocurrency, specifically Bitcoin, to make such a gross error. If you take the time to break it down, it is imperative to realize that Bitcoin is much more than a digital asset. It is a decentralized currency that enables most secure and borderless transactions without the need for intermediaries. There are real-world applications for its underlying blockchain technology as well, which separates it from other speculative fads of the past. After all, the adoption and evolution of Bitcoin from what was once considered a niche experiment to a globally recognized medium of exchange certainly allows it to stand apart from the pack. Corporations known all over the world such as AMC, Tesla, and AT&T even accept Bitcoin as payment, adding credence to just how accepted the currency has become in the world of commerce. Some experts feel that this acceptance challenges others' claims that Bitcoin lacks utility. As a matter of fact, it legitimizes its use as a financial tool. Another factor to acknowledge is the manner in which financial institutions have recognized Bitcoin's innate potential. This likely means that the medium of exchange is bound for integration into mainstream finance. Even industry giants and mainstays such as Fidelity and BlackRock have introduced their own crypto products to allow investors to ease into Bitcoin via regulated platforms. The participation of such venerable financial institutions just reinforces the idea that Bitcoin had long ago transformed from a speculative novelty into an asset class with real credibility. And of course, many claim that the core of Bitcoin's valuation is its costly production, also known as mining. Mining is an arduous process which involves solving complex math problems using powerful, expensive hardware. As a matter of fact, it is an extremely costly operation that is known for the significant amount of energy and resources that it consumes, sometimes ranging as high as $800 to $1,500 to mine one single Bitcoin. These prices are estimates which fluctuate depending on economies of scale, as well as one's hardware efficiency and the current price of electricity. It can definitely be argued that this expensive production cost be a proven sign of Bitcoin's intrinsic value. After all, even the minimum effort needed to bring a single Bitcoin into existence is certainly costly. Therefore, the extensive mining costs represent a baseline value whether or not there is a high market demand at any given point in time. Still, Bitcoin's market value often far exceeds any intrinsic value it may gain as a result of its production. As a speculative investment, its market value can vary greatly depending on investor sentiment, regulatory developments, and of course, broader economic trends at the time, and many times this valuation far exceeds its production cost. Bitcoin has long been referred to and thought of as a digital gold, though that is a misnomer and a misconception about the ways in which cryptocurrency works. Crypto is not, and has never been, a reliable source of value that is immune to the effects of more traditional financial systems. Its extreme price volatility means that this certainly is not a role that Bitcoin is suited for. Bitcoin valuation is more akin to stocks on the market than it is to traditional currencies or stable assets. That means its value can fluctuate dramatically over short intervals of time, making it especially risky for stable transactions and long-term savings due to its rampant unpredictability. After all, cryptocurrencies are driven by not only contemporary market sentiment and supply constraints, but also major external factors such as macroeconomic events and regulatory changes. Fiat currency is stable, and that is why it is incomparable to Bitcoin and other cryptocurrencies. For example, if you take a $100 bill and place it in your wallet, only to retrieve it next year to purchase groceries, it is still worth $100 regardless of the fluctuation that it may have in buying power. At the end of the day, its nominal value remains consistent. Conversely, Bitcoin doesn't keep a predictable measure of value over time, which is a key characteristic of regular money. Even while precious metals like gold may fluctuate, they remain pretty steady when compared to the dramatic price shifts of Bitcoin. As a matter of fact, Bitcoin can gain or lose thousands of dollars in value over a period of a few hours. Other proponents of Bitcoin argue that there is a growing number of high-profile merchants that accept the cryptocurrency as payment, therefore solidifying its status as an alternative to traditional money. But as you can see by our analysis, this comparison is flawed. There are far more distinctions to be made between Bitcoin and fiat currencies than similarities. Speculative trading and investment are, for now, the primary uses for Bitcoin, rather than fiscal transactions or wealth preservation. And while these transactions certainly do exist, these instances are still few and far between. The idea that Bitcoin or any other type of cryptocurrency will one day replace traditional government-backed currencies is laughable. Though the very idea is quite controversial, it has been gaining steam via social media and internet platforms. As we have already discussed, this scenario is quite unlikely. There are significant barriers that prevent Bitcoin from replacing established financial systems and conventions, not the least of which is the fact that its day-to-day value can be extremely volatile. It also has limited use when it comes to everyday transactions due to its restricted scalability. So, while Bitcoin has certainly introduced revolutionary concepts in the field of digital finance, it is quite unlikely that it will supersede fiat currencies at any time in the foreseeable future. A common misconception that is still making the rounds is that Bitcoin's existence can be directly traced to the 2008 financial crisis. Many think that it was created in response to the plight designed to replace the US dollar. However, this is merely a coincidence since it was created within that time frame, but there is really no clear evidence to link Bitcoin to what was going on at that time economically. In reality, Bitcoin was designed to be nothing more than what it still is, a decentralized digital cryptocurrency that can be used in given situations as an alternative to traditional money that is both transparent and mostly independent from central authorities. That said, as we have already delineated, the currency should be thought of more as a supplementary choice rather than a replacement for fiat currencies which serve the purpose of performing multiple complex financial functions. First of all fiat currencies, which of course include the US dollar, have been deeply embedded in local and global economies for centuries. They have evolved with the times, supported by their respective governments as well as regulatory institutions and central banks. They not only serve as a medium of exchange, but they are legal tender used to manage inflation, stabilize economies, and implement monetary policy. In other words, we would have to restructure the entire global financial infrastructure if we attempted to replace such a venerable and dependable system. This, too, would carry great risk. Let's first take a look at Bitcoin's scalability issues. The transaction processing capabilities of Bitcoin are far more limited when juxtaposed with traditional payments, such as MasterCard or Visa, which can process thousands of transactions each second, or even PayPal, which is far quicker and easier to use. The blockchain processes a much smaller number of transactions, so higher fees and delays are imminent during times of heavy usage. Clearly, when it comes to supporting the sheer volume of transactions that are necessary in a global economy, Bitcoin just won't cut it at this point in time. And it goes without saying that volatility is a huge issue, if not the largest obstacle of all. This is one of the reasons most merchants reject the use of Bitcoin as a payment tender. They rightfully fear that the value of a transaction tendered by Bitcoin will decrease significantly by the time it is fully processed. That is why it remains an iffy proposition when it comes to everyday commerce. That all being said, Bitcoin has gained some traction as a legal tender and payment method in many countries, including El Salvador. However, these situations are definitely the exception and not the norm. It is primarily niche use matters that drive such blanket adoptions. These can include speculative investment, enthusiasm from technology sectors, and early adapters. But a more thorough replacement of fiat currencies would be unlikely due to social resistance from any government or institution that heavily relies on a centralized financial system. The decentralized nature of Bitcoin would pose unique challenges anyhow when it came to crafting economic policy and properly managing inflation. Conversely, fiat currencies are used by central banks to control the money supply, stabilize the economy, and influence interest rates. With a fixed supply of Bitcoin, the cryptocurrency's flexibility is severely limited. This means that it would be difficult to address any macroeconomic difficulties, such as deflationary spirals or recessions. This is just silly, considering how notorious Bitcoin mining is for its massive energy consumption. Some recent estimates have even hinted at the process using as much energy in a year as a small country does in the same period of time. The formation of such a substantial carbon footprint certainly challenges any claims that Bitcoin is in any way environmentally friendly. There are many more sustainable alternatives to traditional financial systems that are much greener and much more conscious of the effects of non-renewable energy use. As a matter of fact, the energy-intensive mining process of Bitcoin stems from what is known as its Proof-of-Work Protocol, or POW. Miners must solve complicated mathematical equations in order to validate transactions and add new blocks to the blockchain. This requires extremely powerful hardware that needs significant amounts of electricity in order to function. This process is not an option, and its use is not negotiable. It is incorporated in order to prevent fraud and ensure network security. That all said, it still comes at an environmental cost that cannot be prevented. This reliance on such power-sucking mining has made those that are otherwise on board a bit hesitant. This discussion has become a sticking point to some when arguing that Bitcoin is simply not green enough to depend on for everyday use in transactions and trading. However, it should be noted that this energy-demanding mining mechanism is unique to Bitcoin and other cryptocurrency that requires the use of POW. Cryptocurrencies that depend on different blockchain technologies, such as proof-of-stake or POS systems, are much more environmentally friendly, necessitating far less energy to validate transactions. Thankfully, the creation of these alternatives demonstrates just how committed to environmental concerns the industry has become. A great example of this transaction is Ethereum, a popular cryptocurrency that now uses POS technology. And it is not only the sheer amount of energy that keeps certain cryptocurrencies from becoming a green alternative. It is also the specific types of energy sources that are being used. In regions where fossil fuels such as coal and natural gas are relied upon heavily for use in mining processes, the amount of dangerous carbon emissions can be troubling. Fortunately, there are mining companies, as well as particular countries, that are shifting toward renewable resources such as solar, hydroelectric, and geothermal power. As a matter of fact, there are many regions of the United States, not unlike Iceland, that host cryptocurrency mining farms that are completely powered by both geothermal and hydroelectric energy. These efforts can greatly reduce the enormous carbon footprint that has long plagued Bitcoin and its contemporaries, leading to better outcomes for everyone involved. It should be mentioned, however, that the broader implications of past Bitcoin mining endeavors have had a devastating impact on power grids in general. This is still very much a concern in areas with limited access to renewable energy sources and infrastructure. Mining in all forms can strain local grids and, ironically, increase local reliance on the same fossil fuels that miners are already trying to avoid. Of course, this consequence is exacerbated due to the many miners already driving their operations to areas where electricity tends to be inexpensive. Bitcoin's original promise and allure was the fact that it was described as a decentralized currency that was 100% free from control from both governments and central banks, while it maintained an increasingly regulated framework. It should be said, this simplified explanation of Bitcoin, as well as other cryptocurrencies, is outdated and has been repeatedly debunked. Most global governments in the past few years have developed measures used to tax, monitor, and regulate cryptocurrency transactions, thus reshaping its role within the financial ecosystem. So, while it is true that Bitcoin was originally established in order to provide a secure and decentralized currency, it certainly has not remained regulation-free. Take, for instance, the Bank Secrecy Act in the United States, which has been amended since 2013 to include cryptocurrency. This means that the Financial Crimes Enforcement Network, or FinCEN, a division of the Treasury Department, has been tasked with overseeing all transactions involving cryptocurrencies for the purposes of preventing illicit activities such as money laundering and fraud. And don't forget, in the United States, the IRS classifies all cryptocurrency as digital assets, not unlike stocks, bonds, and other capital investments. That means that whether Bitcoin is being held for the purposes of short-term trading or as a long-term investment, it is still taxable under the country's laws, and its gains and losses will be reported. Other nations, including the UK, India, and China, have taken the time to implement similar tax policies and regulatory structures. Some jurisdictions have even enacted specific laws to ensure accountability in crypto transactions. These include requiring all exchange and wallet providers to implement Know Your Customer and anti-money laundering protocols. That all being said, integrating all these regulations has been at the expense of Bitcoin's alleged financial independence.